Real estate investment practice problem using OneNote. Shared appreciation mortgage. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab down in the 5150 Shared Appreciation Mortgage tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems, they're also in the text area with the same name, same number, however, with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're doing another variation of the loan. We're going to compare and contrast that with the standard loan, the standard 30-year fixed. That would be the typical kind of way I would approach any kind of variation of the standard type of loan. The new thing that we're going to be added with the shared appreciation mortgage is the concept that the lender wanting a piece of the appreciation in the property in order to give some more favorable terms, possibly a lower interest rate. Let's see how that would play out. First, just looking at a standard 30-year fixed loan at the 100,000, years 30, months 360, rate 10%. In this example, payments could then be calculated using the PMT payment function, 877.57. Amortization table then can be constructed with the payments all the same all the way down, interest and the loan reduction then being split out, the interest decreasing as the loan goes by, the loan reduction increasing, and the loan being fully amortized at the end of the term, at the end of 30 years or 360 payments indicated by the zero down below. Let's see what the difference will be from our new factor here. So we have our data. The data will be the home at 110,000 we are imagining. We're going to be putting down 15,000, which is about 13.64%. And that means the loan amount, 110 minus the 15,000, will be the 95,000 in this example. We still have the 30-year, 360 payments. The rate we're going to say is 8%. Now, the scenario we can imagine here then, and notice that this is a little bit less standardized of an agreement, but you can see the essence of the agreement, how this kind of agreement could work out, right? We'd say, hey, look, we want to get a loan. We'd like to get a lesser rate. We'd like to get a smaller payment. How, are there any ways or options we can do this? We looked at some options in the past, which would be reducing the risk with regards to the inflation going up over time with an adjustable rate, or having the adjustment of inflation, for example. Those are two methods of taking risk off the lender, putting them more on the borrower, and in return, the lender often then being able to offer more favorable terms due to having less risk that they are taking on. Another option could be that there's a share of the appreciation in the property. So if the assumption is that the property is going to be going up in value, the lender might say, hey, look, if you give us a piece of the appreciation in the value of the property, then we can take that into consideration and possibly then give you a lesser rate based on that kind of sharing of the increase in the value of the property. So the assumption here then would be that the 8% is a favorable rate for whatever basically the environment is, due to the fact that there's going to be some shared appreciation, which we're going to say is 30%. So the value of the property goes up, there's going to be a shared appreciation of the 30%. Now, notice the details that's the kind of essence of it. The details of it can get a little bit, you want to make sure that you're covering all the bases on this kind of thing, because you could then ask, well, how long could I hold the property? Can I just hold the property forever and then I never sell the property, and therefore I never have a realization of a gain? I never have to give you your 30% of the sales price. Well, you would think no, the bank was probably going to say, hey, look, we want you to either sell the property or realize the gain of the property in some time period in the future. We're basically going to say 5 years here. So the assumption is going to be that we sell it in 5 years. You might then say, well, what if I want to stay in it in 5 years? You might then look at the terms of the agreement and see whether or not the terms of the agreement would allow then for you to have an appraisal on the property possibly and pay off the amount of the appreciation at that time, or continue it forward or something like that. And you also could see a situation, you might say, well, what if the property goes down in value? The assumption generally would be that you wouldn't owe anything on the appreciation in the property if the property declined in value. But again, that's something that you'd want to make sure that you're listing out in the agreement. So again, the bottom line is that the idea would be you got the property at $110,000, you got a $95,000 loan. We're going to give a favorable rate, assuming the property is going to be going up in value over the years in the future. We would like to assess it or sell it in 5 years, and then you pay us 30% of the appreciation in the value of the property. That's the general idea. So then if we were to do our calculation, the actual loan is fairly straightforward, same kind of structure on the loan that we've seen in the past. But then when we think about basically selling the loan and our options in the future, we have to take into consideration the appraisal and the 30% interest to the lender in that case. So for example, if the payment calculation, same kind of calculation here, we're going to say negative PMT. The rate would be the 8% rate that they gave us divided by the 12 to get to the monthly rate, comma, number of periods would be 30 times 12 or 360, picking up the 360, comma, present value simply being the $95,000 value of the loan. We would have the payments at the $697.08 at the payments. We're going to say that we're going to be holding it for 5 years and then sell it and or at least assess it to assess the 30% participation in the lender. The lender is saying we want to have a 30% participation, so we expect you to hold it for 5 years and basically assess it or sell it at that point, giving us then 30% of not the sales price, but the increase, the appreciation over the cost of the $110,000. So then we're going to assume then we're going to say that the home appreciation is 25% at the point in time that you're making the loan. This, of course, would be one of the assumptions that you would make. You'd say, okay, well, does this make sense for me from an investment standpoint? How much will the loan appreciate in value? We can assume that it's appreciating 25% here, and that after 5 years we could sell it for or appraise it at $137,500. If that's the case, then how much would we have to pay off to the lender? Well, we'd have the balance that we would have to pay off to the lender. That would be the balance of the loan that is still going to be owed out. And we can calculate that using a formula, or we can use the amortization table. In other words, if I looked at the amortization table after 5 years, $90,316. So we'll do that in a second, $90,316. Or we can do a calculation for it in terms of a present value calculation, which would be the sum of the payments from that time. So we could say negative present value. The rate would then be the 8% divided by 12, comma, then the number of periods would be the 30 minus 5 or 25 in years. And then we'll multiply that times 12 to get to the months. And then comma, the payment would be the payment calculation of the $697.08, getting us once again to that ending balance. So this would be how much we would have to pay off. So in other words, if we sold it, and we'll take a look at this calculation a little bit more in depth in a second, but if we sold it for $137,500, we would have to pay off the bank that $90,316.36 from the loan that was left over, and we would have to pay the appreciation on the loan or 30% on the property or 30% of it. In other words, the property went up in value. If we sell it for $137,500 minus the cost, not the loan amount, but the cost, $110,000, it went up in value by $27,000. If we take that $27,000 times 0.03, 30% of that, hold on a second, 0.3, not 03, let's do it again. 137,500 minus 110,000 gain times 0.3, 30%, would give us then the 8250. So that 8250 we'd have to pay over and above the loan amount. So we have that plus the loan amount, 90316.36. We'd have to pay off the bank 98,566. So that's the general idea of it. Now we could then say, okay, well, what is really the rate if I roll that cost in? So in other words, if I kind of pick up that cost and I make a projection, what is the effective rate that we would be using? Because remember that effective rate is a rate that we can then use to determine if it's a good investment for us. That's one of our tools that we can kind of use. So try to roll in the cost of this 30% appraisal from the bank and see if we could roll that into the effective rate. So for that, we could use the rate function, or we can use an IRR calculation. We'll take a look at both of those formats here. So we could say the rate would be the number of periods. The number of periods would be, then we could think of it in years. We could say 30 years. I'm sorry, not 30 years, 5 years. We could say 5 years times 12 to then get the number of months. So 5 years times 12, comma, the payment would be the $697.08 for the payment. The present value would be, and it needs to be the negative in the present value, would be the amount of the loan, the $95,000, and then comma, the future value is basically what then we have to pay back to the lender, which is going to be this $98,566. We take that entire thing, which would then be the monthly amount, multiply it times 12 to get the yearly rate. That would be about 9.4. Now, this might be a little bit more intuitive if we do this with the IRR calculation, looking at the cash flows, and so we'll see that shortly. Now, if we were to construct the amortization table, straightforward amortization table, so we're assuming to sell it or at least appraise it after 5 years, but we still have just a 30-year amortization table, so the $95,000 was the loan amount we had up top. Then we calculated the payments to be about $697 on the payment. The interest calculated all the way through with the same rate of that 8%, which we're assuming is a favorable rate due to the sharing of the appreciation. And then that's going to be the same all the way down, just a standard amortization table. It'll go all the way down to 30 payments and be fully amortized on down, meaning ending balance is 0. That being the case, however, we've kind of agreed here that we're going to basically focus in on a 5-year time frame, either selling the property and or appraising it at that time and looking at the appreciation at that point. And that's what we're assuming basically our agreement is in order to get the favorable rate. So we can look at that in a little bit more depth in terms of assuming, let's just assume we were to sell it in 5 years and do those same calculations we looked at up top in kind of like a table type of format. So if we sold it in 5 years for $137.5, and that $137.5 is something we'd have to assume up front, because we'd have to say, I'm assuming it's going to go up 25% to try to see what the costs will be, considering we have to share part of that gain with the lender. Then we'd say, how much are we going to have to pay to the lender in order to consider how much we're going to keep in terms of proceeds? So we're going to say the loan balance was $90,316, which again, we could calculate, or we could probably, more likely, I would get it from the amortization table here, which would mean after 5 years, we got the $90,316, which we still owe the lender. So if we sell it at that point in time, just like normal, nothing new, we would have to pay them that $90,316. However, the new thing is that we would also have to give them a portion of the appreciation in the property. So for that, we're going to say, how much did it appreciate by? We're just going to say that we sold it for, once again, that $137.5, same sales price, and the cost is not the loan amount. That was $95,000. The cost is what we purchased it for. So the appreciation is going to be based on, the cost versus the sales price. So the cost $110, $137.5 minus the $110 gives us a $27,500 appreciation increase in the value of the property. If we then take 30% of that going to the lender, because they're sharing our appreciation, we get to the $8,250. So now we got to pay back the loan at that point, $90,316 if we sell it, plus we'd have to be paying off the $8,250. So if we add those up, we get to the $98,566. And so in essence, we'd have then, if we sold it, $137.5 minus the $98,566, we'd have basically the $38,934 proceeds. This isn't really the gain we're calculating it for taxes, or this is, the proceeds after we pay off basically the loan amount. So that'd be the general kind of idea here. If you calculate the IRR, and note that you might have an agreement, and like I said, these agreements are less standardized of a process, but you could have an agreement basically saying, hey, look, what if I, after 5 years, want to pay you off of the appraisal value, taking the appraisal, paying off the 30% at the $8,250, keeping the property, and continuing to pay the loan down for the rest of the 30 years or something like that. You could imagine an agreement like that being in place. The general concept, of course, being that the lender lowers the rate in exchange for getting some participation in the appreciation, which they'd have to define some way so they can do a rational calculation on, the benefits of it. So if we do an IRR calculation, which could give us a similar idea of this effective cost, it would look something like this. In period 0, we got $95,000 from the lender, and then we used it to purchase the home. Then we got the outflows of the $697, and we're doing it on a monthly basis all the way down for 5 years, 5 times 12 being 60. So now we're down here at 60. And then at the last one, we got this added twist, because now there's going to be an outflow if we sell it of $90,316 plus the $697 that we got to pay, plus we've got to pay that $8,250, the share of the appreciation in the value. So that's going to give us that $99,263 outflow back to the lender at the end. Net flow $45,391, and the IRR, the rate at which this series of payments would be 0 then, is 9.4%. So if I scroll back up and say that 9.4%, that's what we calculated here on the effective rate. To me, this IRR calculation is a little bit more intuitive, can either be used as a check to the effective rate calculation and or, as a substitute for it. So notice that if you're doing this kind of agreement, then you're making estimates into the future again. You're trying to say what's going to be the appreciation in the property, how much am I going to have to pay to the bank, and then what's going to be my return in on it. So, for example, if you have the same kind of setup, the same kind of problem, you might then look at your effective rate, oftentimes when you're thinking about these kinds of investments, as the rate at which you can compare to other projects. So if you're comparing other projects or other investment opportunities, you might be saying, hey, look, I'm going to take into consideration what I think my required rate of return is, the rate that I expect to have a return, and possibly vary that depending on the degree of risk that is involved. So if you look at this, you might say, I would like to set this effective rate, for example, to about 15%. You're saying, I want if I'm going to take on this risk into the future and whatnot, I want an effective rate based on my calculations on what, I want to put my money on for a 15% return. So if you did this, and we do this in Excel, and you have everything set up in this format tied together, then your question would be, well, how much would the property have to sell for in the future in order to generate a rate of return or an effective cost of 15%? And you could do that using a tool in Excel called GoalSeek, meaning, and that tool will basically say, I would like you to set this cell to 15%, about 14.99, by changing this cell up top. In other words, change this cell, the percentage increase in the appraisal, which will then calculate the resale price to whatever it needs to be, so that I get an effective cost here of the 15% about. And that's one way you can kind of try to think about whether these types of different scenarios using that GoalSeek and then back into the appreciation. So if that were the case, it would have to go up by $145,065, which would mean the sales price would have to be $270,213. If we saw that calculation, if it sold for $270,213, the loan balance is going to be that $90,316 we get from the amortization table, $90,316. And then we'd have the $270,213 minus the cost, which would still be $110, giving us an appreciation of $160,213. We take that times 30%, the amount that then is owed to the lender. They get the 30% or $48.64. So that means that the loan balance, $90,316 plus that $48.64 is what we owe back to the lender, $138,380. The sales price minus what we owe to the lender gives us then that $131,833 balance. And if we were to calculate our IRR on this, there's the 95, here's the the 797 each period, and then at the end of 5 years, we'd have to pay off. This time, we'd have to be paying off the $90,903.16 plus that last payment, $697, and the bank, we'd have to pay them off for the appreciation, which would be $48,064 in this case, $48,064. That would give us our $139.77, and that would give us then our rate at which this series of payments would be zero, which would be the 14.99 or about 15%. So those are some tools that you can kind of use on here. We have this in Excel. We work through this in Excel if you'd like to kind of work through a practice problem in Excel with this. We also have this worksheet in Excel in the example problem, so you can look at that and use it for whatever purposes it might be useful for.